Everyone has heard the phrase, investing is the key to building wealth. But what does that really mean? In simple terms, investing is about setting aside your money today so it can grow and create more value tomorrow. It's the process of letting your money work for you, instead of you always working for money.
Hey everyone, welcome back to Steadily Academy, where we turn complexity into clarity, breaking down money, investing, and financial growth so you can make smarter financial decisions.
In today's video, we'll break down the basics of investing, what it is, how it works, and the main ways people invest their money to build long-term wealth. We'll cover everything from stocks and bonds to mutual funds, hedge funds, pension funds, and even real estate, explained in an easy, beginner-friendly way. Let's get started. Understanding what investment really means. Investment is basically the process of using your assets, whether that's money, property, or something else, to earn a return. Instead of spending everything you earn, you put some aside in places that have the potential to grow. This could be anything from buying company shares to owning property or lending money to a government or business. The idea is simple. You delay spending now so you can have more in the future. Let's start with stocks, one of the most popular forms of investment. When you buy a stock, you're purchasing a small piece of ownership in a company. If the company performs well, your share price might go up. If it struggles, your share price might drop. That's why stocks are often seen as high-risk, high-reward investments. There are two primary ways to make money through stocks. Dividends. These are regular payments that companies distribute to their shareholders as a share of their profits. And capital gains. This happens when you sell your stock for more than you originally paid. If you sell it for a profit, it's called a capital gain. If you sell it for less, it's a capital loss. The place where stocks are traded is known as the stock exchange, a marketplace where buyers and sellers meet. In the past, investing in stocks required brokers and phone calls. But today, anyone can buy or sell stocks instantly using mobile apps and online trading platforms. Technology has made investing more accessible than ever. Now let's talk about bonds. If stocks make you an owner of a company, bonds make you a lender. A bond is like a formal IOU issued by a company or a government. When you buy a bond, you're lending them money, and in return, they promise to pay you back later with interest. Bonds are generally more stable than stocks, and are often used by investors who want consistent, predictable income. Each bond has three key elements: coupon rate, the interest rate paid to the bondholder; maturity date, the date when the bond issuer must repay the full amount; and par value, the amount that will be paid back to you at maturity. Because of their stability, bonds are often considered a safer part of a balanced investment portfolio. For investing to exist, there must be a financial system, a network that connects people who save money with those who need to borrow it. This system allows money to move efficiently between savers and borrowers through institutions known as financial intermediaries. These intermediaries include banks, mutual funds, pension funds, and hedge funds, all playing different roles in the investment ecosystem. A mutual fund is like a group project for investors. It pools money from many people and invests it across a wide mix of assets, such as stocks, bonds, or other financial instruments. This diversification helps reduce risk because your money isn't tied to the success or failure of just one company. Mutual funds are professionally managed, which makes them a great choice for people who want to invest but don't have the time or experience to pick individual stocks. Next up, hedge funds. These are private investment organizations that use more complex and sometimes riskier strategies to try and achieve very high returns. They often require large minimum investments and are generally open only to wealthy or experienced investors who can afford to take on greater risk. While hedge funds can generate huge profits, they can also lead to significant losses, which is why they're not suitable for beginners. A pension fund is another type of financial intermediary, but with a very specific purpose: securing income for people after they retire. Employers and employees contribute money into the fund over time, and that money is then invested in various assets to help it grow. When a person retires, the fund pays out regular income, often for the rest of their life. In some cases, people may also qualify for pension benefits due to injuries or long service. Pension funds are one of the most powerful examples of how investing can provide long-term security. Another major form of investment is real estate. This involves buying property with the goal of earning rent or selling it later at a higher price. Unlike stocks or bonds, real estate is a tangible asset. You can see it, use it, and often improve its value over time. Although it usually requires more money up front, real estate can be an excellent long-term investment because it tends to appreciate in value. It also provides a steady cash flow when rented out. Many successful investors build their portfolios by combining real estate with other types of investments to balance risk and reward. One of the golden rules of investing is diversification. This means spreading your money across different investment types, like stocks, bonds, mutual funds, and real estate, so that a loss in one area doesn't wipe out everything. Diversification reduces risk and provides more stable returns over time. It's the smart way to grow wealth steadily while protecting yourself from sudden market drops. And finally, here's one of the most important truths about investing. Time is your greatest ally. The earlier you start investing, the longer your money has to grow. Even small amounts can grow into something significant thanks to years of steady returns. Think of it this way: the best time to invest was yesterday, and the second best time is today. Consistency and patience always win over short-term speculation. Investing isn't about luck or chasing quick profits. It's about making informed, long-term decisions that align with your goals. By understanding how stocks, bonds, mutual funds, pension funds, and real estate work, and by diversifying wisely, you can set yourself up for real financial freedom. Remember, wealth is built, not wished for, and investing is one of the most powerful tools to make that happen. If you found this video helpful, don't forget to hit that like button. It really helps us reach more people who want to learn about personal finance and investing. Make sure to subscribe and turn on notifications so you never miss our weekly videos that simplify the world of money and smart decision-making. And if there's a topic you'd love to learn about next, just drop it down in the comment section below. We read every single one, and your idea might just be our next video. Thanks for watching, and we'll see you in the next one.